Hi everyone, welcome back. In this session, we're going to discuss a topic named constant yield price trajectory. Now, before explaining what constant yield price trajectory is, let me actually start off with an example. Let's say there is a bond which has a time to maturity of 5 years. It has got a coupon rate of 9% per annum. The face value is $1,000. The face value, remember, is also called as the par value. Whenever I refer to the word par value, it also means I'm referring to the word face value. Redemption value, in this case, I've assumed it to be equal to the par value of $1,000. And in majority of the cases where the question is silent, you're required to make an assumption that the redemption value is actually equal to the par value. And now the next one I've assumed is the required rate of return being 11%. Now required rate of return is nothing but YTM. So YTM in this case is 11%. Now if I actually ask you to calculate the intrinsic value of a bond, what I would require is I want each of you to actually pause this video, especially the CA final students. I want you guys to pause this video, make a typical tabular format where we have here cash flows, present value factor at 11%, and then we have the discounted cash flow. And when we make a table for all 5 years, and then we take a sum of the discounted cash flows, and that sum is nothing but the intrinsic value. What we have effectively done here is we have mathematized the value of a bond, which is nothing but the present value of all the future cash flows discounted at the required rate of return. The future cash flows being coupon of $90. $90 is nothing but $1,000 multiplied by 9%. So we have coupon of $90, which we're going to receive for 5 years, year 1, year 2, year 3, year 4, and year 5. And then we have the redemption value of $1,000, which we will be receiving at the end of the 5th year. All right, so I want every one of you to actually pause this video and then finish this sum and finish this table and calculate the intrinsic value of a bond. Now, I'm not filling out this table because I will be using the Excel function. I will be using the Excel function of equal to PV. So intrinsic value is equal to PV. It's first asking me to input the rate. The rate is nothing but 11%. The number of periods refers to the remaining time to maturity, which is 5. And then it's asking me the payment per period. PMT refers to payment per period, which in our case is 90, which is nothing but the coupon. And then it's asking me for the face value, for the future value, which is nothing but $1,000, which is the redemption amount. And then type is going to be 0 because I'm going to receive all the cash flows at the end of each period. I'm not going to receive cash flows at the beginning of year 1, year 2, year 3, year 4, year 5. I'm going to receive the cash flows at the end of year 1, year 2, year 3, and so on. So we will select the end of the period, which is nothing but 0. And when I hit enter, I get an intrinsic value of 926. Now the meaning of this 926 is if I want to buy this bond and I require a rate of return of 11% from this bond, if I am wanting to buy this bond and I want a rate of return of 11% from this bond, then the maximum amount I'm supposed to pay for this bond today is 926. The price that I'm supposed to pay for this bond today is 926. Does it mean that this is the actual market price that you see on the exchange? The answer is no. This is not the market price. This is called as the intrinsic value or the true value of a bond. Market price, remember, is always determined by demand and supply, which is also influenced by other factors. The other factors will not come into play in the long run, but in the short run, market forces will also include the other factors, which is not captured in the intrinsic value. Okay, so the intrinsic value is 926, and this intrinsic value is always denoted as IV0. It's denoted as IV0. Now, actually, when we, although I'm writing it in Excel like this, when we actually write it in an exam, we always denote IV0 as, we denote 0 as a subscript. We denote IV0 and we denote 0 as a subscript because what we're trying to say is this 0 is actually time equal to today. T equal to 0 always refers to today, right? The word T equal to 0 always refers to today. And what we are trying to say is this is the intrinsic value today. IV0 refers to intrinsic value today. But for the purposes of Excel, I'm denoting it in brackets because obviously I cannot spend time for actually denoting it as a subscript. But the true way of actually denoting it is IV and then subscript 0, where 0 refers to today. So this is the intrinsic value today. This is the intrinsic value of the bond today. Now, if you actually imagine, this bond is a 5-year bond. This bond is a 5-year bond. And as days pass by, the intrinsic value of this bond is obviously going to change. The intrinsic value of this bond is obviously going to change, because if you remember, if you're able to see the formula, we have used 5 years. We have used 5 years as one of the input for calculating the intrinsic value. Now, if I keep changing this input, obviously the intrinsic value of the bond will keep changing. All right. So if we keep reducing the time to maturity, obviously the time to maturity cannot increase. Time to maturity only can decrease as days pass by. Right now we have 5 years to maturity. If 1 year passes by, we'll have 4 years to maturity. If another year passes by, we'll have 3 years to maturity, and so on. So now basically what I'm trying to say is, as the time to maturity keeps reducing, obviously the input in this present value equation will keep reducing. The input will keep changing, and then that will cause a change in the intrinsic value of a bond. Therefore, the intrinsic value of this bond is not going to be 926 from today till the end of the 5th year. The intrinsic value of this bond is not going to be 926 from today until the 5th year, but the intrinsic value is actually going to keep changing, because the time to maturity will keep reducing. As and when we keep reducing the time to maturity, obviously the intrinsic value will keep changing. Now, price trajectory, the word price trajectory means what is the path that this intrinsic value. Now, whenever we utter the word price or intrinsic value, we are generally using it interchangeably, but please always remember the difference. Don't forget the underlying difference between price and intrinsic value. But at large places, generally, whenever we utter the word intrinsic value, we also try to assume equilibrium, where the market price is actually equal to intrinsic value. Generally, it not necessarily is a case where market price is always equal to intrinsic value, but for the purpose of discussion, unless otherwise specified, we assume an equilibrium situation where intrinsic value is actually equal to the market value. So now the word price trajectory basically means what is the path that the price is going to follow? What is the path that price is going to follow from today till the end of the 5th year? This bond has got 5 years to maturity. What is the path that this price of the bond will actually follow from today till the end of the 5th year? That is called as price trajectory. We are trying to look at the path which the price is going to follow from today till the end of the 5th year. End of the 5th year is nothing but the maturity date of the bond. All right. So that refers to price trajectory. Now, obviously, as years pass by, if you look at this, if you look at the formula that we have used to calculate intrinsic value, there are 4 inputs that are going into it. The first input is obviously the required rate of return, which is 11%. The second input is the number of years that are left for maturity. The third input is the coupon rate or the coupon amount. And the fourth input is the redemption value. So these are the main 4 inputs that are going. The fifth one, which is 0, is obviously not really an input. It is implied always that the cash flows are received at the end of each period. So now there are 4 main inputs that are going. If you actually see, $90 of coupon and $1,000 of redemption value are never going to change. They're not going to change over the life of the contract. $90 of coupon is based on the contract entered between me and the company, and the $1,000 of redemption value is also based on the contract which is entered between me and the company. Therefore, $90 of coupon and redemption value are never going to change. But the other two factors may change. The first one obviously is the time to the second, or rather this one, the second input that we are giving is time to maturity, which will always decrease as days pass by. The time to maturity can only decrease; it cannot increase. Obviously, the first input, which is the required rate of return. Today, given the market conditions, I want a required rate of return from this bond of 11%. Does it necessarily mean that even 1 year afterwards, I'm going to want a required rate, if I'm going to want a return of 11%? The answer is no. 1 year later, based on the prevailing market conditions after 1 year, my required rate of return may change. My YTM may actually change. I might want a return of 12%, or I might want a return of 10% or 8%, or whatever the case is, based on the market conditions after 1 year. This 11% is based on the market conditions today. Today, from this bond, I want a return of 11%. 1 year later or 2 years later, it is not necessary. It is not necessary that I would want a return of 11% even after 1 or 2 years. Okay, so if you actually see, the last 2 inputs are always constant, which is the coupon and the redemption value. The first 2 inputs YTM may change, either it may either increase or decrease, or it may remain constant as well. I'm not saying it has to change. It may increase, it may remain constant, or it may decrease. Whereas time to maturity always decreases. The remaining time to maturity always decreases. Now in constant yield price trajectory, what we are going to do is we are assuming that the yield will remain constant. We are going to make an assumption that yield remains constant, and that is the reason we have constant yield. The first two words are constant yield. Okay, so what we are going to do is we are going to change only the time to maturity. We are going to keep reducing the time to maturity. Although the yield in real world can change, from 11 to 12 or 11 to 10, we are going to assume constant yield, and then we are going to see the path that the prices of this bond is going to take. We are going to assume a constant yield, and then we are going to calculate the price, or we are going to see the path in which the price of this bond will actually move from today till the end of the fifth year, which is the maturity of the bond. Let me repeat myself once again. We are going to assume a constant yield from today till the fifth year. We're not going to change the yield. We are assuming a constant yield. And then we are going to see how the price of this bond is going to move from today till the end of the fifth year, or the maturity of the bond. So in other words, we are seeing the path in which the price is going to move. And that is the reason the name of the topic is called as constant yield price trajectory. So we are seeing the trajectory of the price, assuming constant yield. Yield constant is an assumption that we are making. In real world, constant yield does not hold good. Yields keep changing every minute. Forget about every year on year. Yields keep changing every minute based on the transactions that take place. Anyways, so you've got the essence of what we are actually going to do. We are going to keep reducing this time to maturity, and then we are going to see how the price is actually going to move from today till the end of the fifth year. Now, let me actually make a table. So the first column I would like to have is time today, which means where are we actually standing. I'll explain this a little more in detail. The next one is basically time to maturity. Third one I would like to have is notation. The fourth one I would like to have is intrinsic value at YTM of 11%. Okay, let me move this time today to here. Yeah. So time to maturity basically refers to how many years do I have left for the maturity of the bond. So I would start with 5 years left. 5 years left is nothing but today there are 5 years left. So if you actually see, this time today is nothing but t equal to 0. So today I've got 5 years left to maturity. If 1 year passes by, at the end of the first year, which means I'm standing at the end of the first year, the remaining time to maturity is obviously going to be 4 years. There's 1 year is going to be reduced from the remaining time to maturity. Now, after another year, I am standing at t equal to 2. And then the remaining years to maturity is then obviously going to be equal to 3 years. I'm standing at t equal to 2, which means from today, 2 years have passed by, and then the remaining maturity of the bond is going to be 3 years. Now, if another year passes by, I'm standing at t equal to 3, and this bond has got 2 years left for maturity. And when I stand at t equal to 4, this bond will have 1 year to maturity. And when I stand at t equal to 5, this bond has got 0 years to maturity. And when I'm saying this, when I'm standing at t equal to 5, what I'm trying to actually imply is I'm standing exactly 1 moment before the redemption of the bond. I'm standing exactly 1 moment or 1 minute before the actual maturity of the bond. Okay, at the end of the fifth year, truly speaking, the bond matures and we do not have any bond outstanding. But when I'm referring to t equal to 5, what I'm trying to say is I am standing exactly 1 moment or 1 minute before the maturity of the bond. But the time to maturity in years is obviously going to be 0, because exactly there's 1 minute left, right? So if I have to translate 1 minute into years, it's going to be point not something. So that is the reason we say that time to maturity is actually 0. So please remember, I'm repeating it once again. When I'm saying that I'm standing at t equal to 5, generally when we speak, obviously at t equal to 5, the bond matures and the bond is cancelled. I receive redemption value and the bond is cancelled. But what I am trying to imply when I write t equal to 5 here is I am standing exactly 1 minute before the maturity of the bond. I'm exactly standing 1 minute before the maturity of the bond, and the time to maturity is obviously 0 years, because 1 minute is obviously point not something years. So obviously I'm ignoring that decimals, and in terms of whole numbers, it is as good as 0 years left for maturity. Now, when I calculated the intrinsic value over here, I basically used 11% as the YTM. 5 periods is nothing but the time left to maturity, because what we actually have to use is present. What the intrinsic value definition is, we have present value of all the future cash flows discounted at the required rate of return. So the future cash flows over here is the cash flows for a period of 5 years, and that is the reason what is relevant for us is the remaining time to maturity. And then I had payment of 90, payment per period of 90, and then the future value of 1000 and type as 0. So I got an answer of 926.08. Now, after 1 year passes by, the remaining time to maturity is only 4 years. The remaining time to maturity is only 4 years. And if I have to calculate the intrinsic value of the bond over here, if I have to calculate the intrinsic value of a bond standing at t equal to 1, over here, I had calculated IV0 standing at t equal to 0. This time today is nothing but actually t equal to 0. Or if maybe I can just make it a little more clear. This is actually t equal to 0. Now 1 year has passed by, and assume that I want to calculate the intrinsic value of this particular bond standing at t equal to 1. Standing at t equal to 1, if you actually imagine, this bond's intrinsic value is going to be the present value of all the future cash flows discounted at the required rate of return. This time, the future cash flows is not 5 coupons, it's only 4 coupons, because 1 coupon has already been received. 1 coupon has already been received because 1 year has passed by. So after that coupon has been received, after the first year's coupon has been received, I am calculating the intrinsic value as the present value, future benefits, which is the next 4 years worth of coupon, and the redemption value, which I am entitled to receive at the end of the 4th year. All right. So over here, when I calculate intrinsic value, obviously it's going to be equal to PV. Rate, we have assumed that it will be constant at 11%. The number of periods this time is only 4, because the first year coupon has already been received. What is yet to be received is only the next 4 years worth of coupons. So number of periods is 4 years. Payment per period is going to be remain 90, and the redemption value is going to be 1000. And when I hit enter, the price has changed from 926 to 937. So as 1 year has passed by, the price has actually changed from 926 to 938. Okay, this is going to be intrinsic value at the end of year 1, which I'm denoting it as IV1. Just like how we denoted intrinsic value today as IV0, I am denoting intrinsic value at the end of first year as IV1. Okay, this is intrinsic value standing at the end of first year, where I have 4 years to maturity. Now the next one I will calculate is intrinsic IV2, or intrinsic value at the end of year 2. Assume that 2 years have passed by from today. 2 years have passed by. So standing at t equal to 2, I am calculating intrinsic value at time equal to 2 when there are 3 years left for maturity. And this time the future benefit is going to be 3 years worth of coupon and redemption value at the end of 3rd year, because the coupon for the past 2 years has already been received. The coupon for year 1 and year 2 has already been received, and after the receipt of that coupon, I am actually trying to calculate the intrinsic value of this bond, where there are 3 years left for maturity. So again, standing at t equal to 2, if I calculate the intrinsic value, it's going to be the present value of the future benefit for the next 3 years. For the next 3 years, because the coupon for the year 1 and year 2 have actually already been received. So again, the required rate of return is going to be 11%. The number of periods is the future periods that we have, which is nothing but 3 years. Payment is going to be 90. Future value is going to be 1000, and then type equal to 0. Now the intrinsic value of this bond has actually further increased from 938 to 951. Earlier at IV0 was 926. IV1 was 938. IV2, which means intrinsic value standing at t equal to 2, where I have 3 years left for maturity, is 951. Okay, so this is the present value of all the future benefits. Future benefits over here is 3 years worth of coupon and the redemption value at the end of the third year. Okay, I mean, at the end of the third year basically refers to from t equal to 2, we just have 3 years left for maturity. That's the reason I said at the end of the third year. Now, if I further calculate intrinsic value at time equal to 3, if I calculate IV at t equal to 3, I am going to calculate IV3, which is going to be the present value of the next 2 years benefits. 2 years benefits meaning the coupon rate for the 4th year and the 5th year, and the redemption value which I'm expected to receive at the end of the 5th year, which is 2 years from today, because right now we are standing at t equal to 3. All right, so this is going to be 11%. Number of periods is going to be the number of future periods, which is 2, and then I have 90, and then 1000, and then 0. I have 966. It has further increased from 951 to 966. Now, and then similarly, if I calculate IV4, which is intrinsic value at the end of year 4, it is going to be, I'm just copying the above formula, it is going to be 982. It's going to be 982, where this 982 is nothing but the present value of the future benefit, where the future benefit is coupon of $90, which I'm going to receive after 1 year, and the redemption value of $1,000, which again I'm going to receive after 1 year. So I am going to receive after 1 year $90 and $1,000 at the end of year 1, standing at t equal to 4. And then the present value of that is nothing but 982. The present value of that is nothing but 982. Now, if I calculate IV5, now when we say t equal to 5, I'm again emphasizing that what we actually mean is we are standing exactly one moment before the maturity. Okay, we are standing exactly one moment before the maturity. And if you actually see, over here, when I calculated IV1, I assumed that the coupon for the first year has actually been received. I've assumed that the coupon for the first year has actually been received. And then I was calculating the intrinsic value after the receipt of the coupon, and I calculated the intrinsic value as the present value of all the future benefits, where future benefits I took only the next 4 years worth of coupon. I did not take the first year's coupon because I've assumed that I've already received it. Once I receive it, obviously the future benefit from buying that bond does not include the coupon for the first year, because the coupon for the first year has already been paid by the company. Okay, the future benefit from the bond after the receipt of coupon for the first year includes only coupon for the next 4 years and the redemption value at the end of the maturity of the bond. Okay, similarly, I made that assumption even at year 2, year 3, year 4, and year 2, year 3, and year 4. What I assumed at year 2 was, I assumed that we already received the coupon for year 2, and then I was valuing the bond. After the receipt of coupon for year 2, I was valuing the intrinsic value of a bond, and I was finding out the intrinsic value of a bond, and I found the intrinsic value of the bond to be the present value of the next 3 years worth of coupon. The reason I took only the next 3 years is because the coupon for year 2 was already received by me, and that is not going to be a future benefit after buying the bond. All right. So similarly, for when I'm calculating intrinsic value at t equal to 5, the assumption I'm making is I have already received the coupon for the 5th year. What is only pending right now is the receipt of the redemption value. Okay, I am making an assumption that I've already received the coupon for the 5th year as well. What is now only pending is receiving of the maturity proceeds of the bond, or receiving the redemption value of the bond. Now, if you actually see, if I just apply the same formula equal to PV, the required rate of return is going to be 11%. Number of periods is going to be 0 because I'm standing one moment before the maturity. So number of periods is obviously 0. Payment per period, I can write it as 90, but that 90 is not going to be received, and that not being received is captured through 0. Once I put the number of periods as 0, even if I put an amount to it, even if I put a payment of 90, it's as good as 90 into 0, which is nothing but 0 itself. And then I have the future value, which is equal to the redemption value of 1000. And when I hit enter, I will get a value of 1,000, and it is going to be common sense. If I am going to receive $1,000 after 1 minute from a bond, what is the present value of that 1,000? The present value of that 1,000 is going to be 1,000 itself, because what impact will the discounting actually have for 1 minute? The impact of discounting is going to be there if I'm discounting it by 1 year or 2 years. Now I'm discounting 1,000 rupees by 1 minute, right? If I'm valuing the bond 1 moment before the maturity, the intrinsic value is going to be the present value of the future benefit discounted at 11%. What is the future benefit? It's going to be $1,000, which is nothing but the maturity proceeds, because I've made an assumption that I've already received the coupon for the 5th year. I've made an assumption that I've already received the coupon for the 5th year. So the future benefit only includes redemption value. Now the present value of that $1,000 is going to be 1,000 because I'm discounting it for a minute, and the impact of discounting it for a minute is going to be minuscule. So obviously it's going to be equal to $1,000. All right. Even forget mathematically, even if you think a little logically, if you know that this bond is going to pay you $1,000 after 1 minute, if you know that one particular bond is going to pay you $1,000 after 1 minute, will you actually pay anything more than $1,000 for that? The answer is no, right? Because if you pay anything more than 1,000, that's going to be a loss for you. Similarly, the seller will not sell it for any amount less than 1,000. The seller will not sell it for any amount less than 1,000, because that's a solid loss for him. Because if he would hold that bond exactly for a minute, he will actually receive 1,000. So why would he actually sell it to you for 900? Similarly, why would you actually buy it for 1,100, knowing that 1 moment later you will only receive 1,000? So the maximum price you will actually pay is 1,000. And similarly, the seller will also be willing to sell it for only $1,000. Otherwise, it would be a loss for him. Okay. So both logically and mathematically, the intrinsic value of a bond has to be equal to the par value. The intrinsic value of a bond has to actually be equal to redemption value. Apologies, it's supposed to be equal to redemption value, but since in 90% of the cases, redemption value is equal to the par value, it is loosely spoken that intrinsic value is supposed to be equal to the par value upon maturity. And now when we're saying upon maturity, what we're trying to say is 1 moment before the maturity. Okay, any bond for that matter should have an intrinsic value equal to the par value. It should have an intrinsic value equal to the par value upon maturity. And truly speaking, it is not par value. It is supposed to be equal to the redemption value. But in textbooks, we generally see that they write that intrinsic value is supposed to be equal to par value, because the redemption value and par value are generally one and the same. In our case as well, we had assumed the same thing. We had assumed the redemption value of $1,000, which was equal to the par value. Okay, and in 90% of the cases, this is actually true, and that is the reason textbooks usually loosely speak that intrinsic value has to be equal to the par value. Intrinsic value has to be equal to the par value upon maturity. Now, if we actually plot this on a graph, but before I plot it on a graph, what I would like to do is I would like to convert these negative amounts into positive amounts, because on a graph, negative amounts actually completely skew the understanding. So I'm just adding a negative signage in front of the formula that we used. I've basically converted all these prices from negative to positive. Okay, so if I plot this on a scatter graph, if I put it like this, let me just move it a little below. Now, on the x-axis, we basically have time. Okay, remember, this is not time remaining for maturity of a bond. This refers to t equal to 0. This refers to t equal to 1. This refers to t equal to 2. This refers to t equal to 3, t equal to 4, and t equal to 5. Okay, this is not remaining years to maturity. Remaining years to maturity actually keeps decreasing. It was 5, 4, 3, 2, 1. What I've taken is where are we actually standing today. Initially I was standing at t equal to 0. After 1 year has passed, I was standing at t equal to 1, and so on. At the end of the 5th year, it means I was standing at t equal to 5, just 1 moment before the maturity of the bond. And on the y-axis, we've got intrinsic value. On the y-axis, we have got the intrinsic value of the bond. Now, if you actually see, $1,000 was the par value of the bond. $1,000 was the par value of the bond, and the intrinsic value today, intrinsic value at time t equal to 0, was actually 928 or something. The intrinsic value was at t equal to 0 was 928, and this is nothing but actually a discount bond. This bond is actually a discount bond because it is trading, or the intrinsic value of this bond is at a value which is less than the par value. The intrinsic value of this bond is less than the par value, and this differential between 1000 and 928 is actually nothing but the discount on this bond. Okay, this bond is called as a discount, and the remaining $80, the difference between 1000 and 928 of $70 is actually the discount on this bond. And this bond, you know, has to be trading at a discount because the required rate of return was 11%, whereas the bond was offering only a coupon of 9%, which means this differential of $80 or $70 is acting as a capital gains for me, resulting in that additional 2% return that I actually wanted. Anyways, that was a separate discussion that we already had. But what I want you to notice over here is this discount bond is actually slowly increasing. It's slowly increasing towards the par value as time to maturity reduces, or as we are moving from year 0 to year 1 to year 2 to year 3 to year 4 to year 5. This bond is slowly moving towards the par value. This bond is slowly moving towards the par value as time to maturity reduces. Okay, as the time on the x-axis increases, what it actually means is the remaining time to maturity of the bond is decreasing. Therefore, as time elapsed increases, the bond, a discount bond, is actually moving towards the par value, which means the price trajectory. Remember, our whole point was actually to see the price trajectory assuming a constant yield. So therefore, the price trajectory for a discount bond assuming constant yield is actually going to be upward sloping, and it is going to move towards the redemption value or the par value. It's going to move towards the redemption value or the par value, both of which were equal in our case. So a discount bond is actually moving. The trajectory of the discount bond is nothing but upward sloping, moving towards the par value, and upon maturity, exactly a moment before maturity, it's going to hit exactly the par value. It's going to be exactly equal to the par value or the redemption value. Remember, whenever I'm uttering the word par value, I'm loosely speaking. Okay, it's not absolutely correct, but textbooks also write it in the same way. All right. So that is for a discount bond. Although over here you might feel that it's looking like a straight line, although over here you might feel it is actually looking like a straight line, the true actually curve for a discount bond is going to be somewhat like this. Okay, let's assume that this is the par value of $1,000. And this is t equal to 5. A discount bond, the intrinsic value for a discount bond at t equal to 0 is actually somewhere over here. This is the 928. Okay, this was 1000, sorry. This is the 928 figure. For a discount bond, it's actually going to be it's not going to be a straight line. Whereas, let me just redraw it. It's going to be a curve. It's going to be a curve somewhat like this. It's going to be something like this. I will just show it to you even in the actual graph, but it's going to be somewhat like this. All right. So it's actually not going to be a straight line, although in the Excel, maybe it might be appearing to you like a straight line. It's actually going to be a curve which is sloping upwards. And the reason why Excel is actually showing it as a straight line is because I have assumed that straight away 1 year has passed by. I have moved from t equal to 0 to t equal to 1, from t equal to 1 to t equal to 2, and so on. Okay. But in reality, I should be actually splitting that 1 year into months as well. I should see how much the price is actually moving after 1 month, after 2 months, after 3 months, after 4 months, and then I should do that for 60 months. I shouldn't be doing it 0 to 1 to 2 to 3 to 4 to 5. I should actually be doing from 0 to 1 month, 1 to 2 months, 2 to 3 months, and I should be doing that for 60 months. And if I do it like that on Excel, I will actually get a curve like this. I will actually get a curve like this. And this curve is representing nothing but the price trajectory of a discount bond. This is representing the price trajectory for a discount bond, where the price of the discount bond is moving from the intrinsic value, which is less than the par value, towards the par value. It is an upward sloping curve towards the par value. This is for a discount bond. And similarly, if I actually do it for a premium bond. For a premium bond, meaning if the bond's intrinsic value right now is, let's say, 1100, if the bond's intrinsic value is right now, say 1100, the price trajectory for a premium bond is also going to be a curve. Apologies, I'm very bad at drawing. Is also going to be a curve, something like this. Okay, just like how the discount bond had an upward sloping curve to moving towards the par value, a premium bond is a bond which is trading at a value more than the par value. A premium bond is a bond whose price is right now more than the par value. A premium bond is going to have a downward sloping curve. It's going to be a downward sloping curve, and even a premium bond's intrinsic value at t equal to 5 will be equal to 1000. It will be equal to the par value. Okay, because for any bond, remember, for any bond, one moment before the maturity of the bond, the intrinsic value for that bond has to be equal to the redemption value or par value. So similarly, this premium bond's intrinsic value will also converge to par value at t equal to 5. It will converge to par value at t equal to 5, but this is going to be a downward sloping curve, whereas for a discount bond, it was an upward sloping curve. Quickly, although I'm not going to show it in absolute detail, if I have to explain it quickly, if I take a separate scenario and I calculate IV at YTM of 8%, if I change the scenario, I'm ignoring this scenario and I'm now calculating intrinsic value at a YTM of 8%. And if I continue to apply the same formula equal to minus PV, I'm using minus at the beginning because I want positive values. Rate is 8%. Number of periods at t equal to 0 is 5 years, and then payment is 90, and then future value is 1000, and then I have a premium bond. I have a premium bond because the bond's intrinsic value today is greater than the par value. The bond's intrinsic value today is greater than the par value, and this is called as a premium bond. And if I just copy this formula and drag it and hit enter, I am going to see that this bond's intrinsic value is actually decreasing as time passes by. As the time to maturity keeps reducing, this bond's intrinsic value is actually reducing, and at t equal to 5, one moment before the maturity, the intrinsic value of this bond is equal to the par value. The intrinsic value of this bond is actually equal to the par value. And if I actually plot this graph, if I plot a graph taking both the cases into consideration, if you notice, the blue dotted lines are for the intrinsic value for a discount bond. The orange dotted lines are the intrinsic value for a premium bond. Okay, if you see, both of them are converging towards the par value at t equal to 5. After 5 years have passed by, one moment before the maturity, both the bonds have an intrinsic value of 1000. The premium bond is a downward sloping curve. The discount bond is an upward sloping curve. Both of them are converging towards the par value or the redemption value. The actual curve actually looks something like this. Okay, this is the price trajectory. This is the path that the price of bond actually takes from t equal to 0 to t equal to 5. Okay, this is the path that the price will actually take from t equal to 0 to t equal to 5, assuming that the yields are constant at 11% or 8%. Remember, these were two separate scenarios. Don't intertwine both of them. One scenario was where I took a YTM of 11% and I worked it out for a discount bond. In a different scenario, in a completely different scenario, I took a YTM of 8% and then I worked out how the intrinsic value actually changes. Okay, so this is the price trajectory assuming constant yield for a discount bond and for a premium bond. Discount bond is nothing but the bond where the price is right now less than 1000. A premium bond is a bond where the price right now is more than 1000. Okay, so for both the bonds, ultimately they are converging towards par value, and they have a discount bond has a upward sloping curve, a premium bond has a downward sloping curve. Okay, that's it for this session, guys. Let me know if you have any doubts. Thank you so much. Bye.